On the morning of Monday, September 15, 2008, at precisely 1:45 a.m., Lehman Brothers Holdings Incorporated filed for Chapter 11 bankruptcy protection, listing $639 billion in assets and $619 billion in debt, making it the largest corporate bankruptcy in American history. The building at 745 7th Avenue still had its lights on. Employees were already clearing their desks. Some cried in the elevator. Some just stood there, holding cardboard boxes, staring at nothing. The decision that put them there had been made 48 hours earlier, in a conference room in Lower Manhattan, by a former Goldman Sachs CEO who believed, genuinely believed, that letting Lehman die was the right thing to do. So here is the question that has never fully been answered: was Hank Paulson saving the financial system, or destroying it? Lehman Brothers was not a young company. It was not a reckless startup. It was 158 years old. It had survived the Civil War, the Panic of 1907, the Great Depression, 2 World Wars, and the dot-com collapse. Founded in 1850 by 3 brothers, Henry, Emmanuel, and Mayer Lehman, in a small cotton trading shop in Montgomery, Alabama, it had grown into one of the most powerful investment banks on earth. By 2006, it was reporting record profits. Net revenue of $21 billion. Net income of $4 billion. CEO Richard Fuld, who had run the firm since 1994, was being called the gorilla of Wall Street. He collected $40 million in compensation that year alone. The firm had survived every financial catastrophe of the modern era, and Fuld believed it could survive anything. But Lehman had made a bet. A massive, quiet, catastrophic bet on the American housing market. Through the mid-2000s, it had aggressively acquired mortgage lenders and loaded its balance sheet with mortgage-backed securities and commercial real estate assets. By 2007, it held more than $85 billion in these positions. When housing prices began to fall, those positions began to bleed. In the first half of 2008, Lehman reported $6.7 billion in losses. Its stock fell 73%. Creditors grew nervous. Counterparties began pulling back. The firm that had outlasted everything was suddenly running out of time, running out of cash, and running out of friends. And then came the decision that changed everything. The weekend of September 12 to 14, 2008, was not a normal weekend in America. Treasury Secretary Henry Paulson had summoned the chief executives of Wall Street's biggest banks to the Federal Reserve Bank of New York, a fortress-like building on Liberty Street, and told them, bluntly, that there would be no government money for Lehman Brothers. None. Paulson, scarred by the political backlash from the Bear Stearns rescue 6 months earlier, in which the Fed had backstopped $29 billion to facilitate J.P. Morgan's acquisition, believed he could not go back to Congress with another bailout. There is no political will for a federal bailout, he told the assembled executives on Friday evening. It was not a suggestion. It was a declaration. 2 potential buyers had emerged. Barclays, the British bank, was willing to acquire Lehman, but needed a government guarantee to cover potential losses. Bank of America was also in the room, circling. Paulson spent Saturday on the phone with both. Barclays chief executive John Varley flew to New York. Negotiations ran through the night. But British financial regulators, the Financial Services Authority, refused to approve the deal without a shareholder vote that would take weeks Lehman simply did not have. FSA Chairman Callum McCarthy reportedly told Paulson's team on Sunday morning that Britain was not going to import America's cancer. The Barclays deal was dead. Bank of America, meanwhile, had quietly shifted its attention. CEO Ken Lewis, watching the chaos around Lehman, had decided there was a better deal to be had. He flew to New York not for Lehman, but for Merrill Lynch, and by Sunday afternoon had agreed to acquire Merrill for $50 billion, a deal hammered out in 48 hours, negotiated while Lehman was still technically alive. Richard Fuld, sitting in his office at Lehman headquarters, was reportedly making phone calls all weekend, trying to find anyone who would buy his firm or guarantee a bridge loan. No one came. At 7:45 Sunday evening, the Lehman Board of Directors voted to authorize the bankruptcy filing. Fuld was said to be in shock. He had believed, genuinely believed, until the very last hour, that someone would come. The light stayed on. The paperwork was filed before dawn. What happened in the next 72 hours rewrote the global financial order. On Monday morning, markets opened to a world without Lehman. The Dow Jones Industrial Average fell 504 points, the largest single-day point drop since the September 11 attacks. But the real damage was invisible and immediate. Lehman had been a counterparty in hundreds of thousands of derivative contracts worldwide. Its failure triggered a cascade of margin calls, forced asset sales, and liquidity freezes that the financial system had no infrastructure to absorb. The Reserve Primary Fund, a money market fund that held $785 million in Lehman commercial paper, announced that its share price had fallen below $1. It had broken the buck, a phrase that sent terror through every retail investor in America who believed money market funds were as safe as cash. Within 48 hours, investors had pulled $300 billion out of money market funds. The credit markets, the arteries of the global economy, effectively stopped working. 25,000 Lehman employees lost their jobs. Pension funds across America and Europe, teachers, nurses, firefighters, took direct losses on Lehman bonds they had been told were safe investments. In Iceland, 3 major banks collapsed within weeks, in part because of their exposure to the credit freeze Lehman had triggered. The Irish government nationalized its banking system. Global trade credit dried up. By October, General Electric, not a bank, not a mortgage lender, but an industrial conglomerate, was struggling to roll over its short-term debt. The real economy was hemorrhaging. In the next 12 months, 8 million Americans lost their jobs. The unexpected consequence was Paulson himself. The man who refused to bail out Lehman spent the following 3 weeks asking Congress for $700 billion to bail out everyone else. The Troubled Asset Relief Program, TARP, passed on October 3, 2008. It was the largest emergency intervention in the history of American finance, and it came directly because the Lehman decision had made the alternative, doing nothing, unthinkable. The man who drew the line ended up erasing it. Richard Fuld testified before Congress in October 2008, telling lawmakers he had been in a fog of disbelief when the end came. He was never charged with a crime. He kept the $300 million in compensation he had earned between 2000 and 2008. He still, to this day, disputes that Lehman was insolvent. There is a particular kind of human failure that is not stupidity, not malice, not even simple greed, it is the failure of imagination. The people in that room on Liberty Street that weekend were not villains. They were experienced, intelligent, highly informed professionals who had spent their careers navigating financial crises. Hank Paulson had survived more market upheavals than most people could name. And yet they could not fully imagine what they were about to do. They could model risk. They could run stress tests. They could calculate leverage ratios. What they could not do was feel, in their bodies, the actual weight of a $639 billion institution ceasing to exist in a single night, and what that weight would do when it landed on everything beneath it. This is the lesson Lehman teaches that no business school course fully captures: interconnection is invisible until it isn't. Lehman was not just a bank. It was a node, a critical, load-bearing node in a web so complex that even the people who built the web did not understand what would happen if one piece was removed. When you are inside a system, you tend to overestimate its resilience, because the system has always recovered before. Every previous crisis becomes evidence that the next crisis will also be survivable. This is not arrogance, exactly. It is a kind of experience-based optimism that becomes, under pressure, a catastrophic blind spot. The deeper truth is about moral certainty. Paulson was certain he was doing the right thing. Fuld was certain someone would save him. British regulators were certain they were protecting their own system. Ken Lewis was certain Merrill Lynch was a better deal. Every person in every room that weekend was absolutely certain. And the certainty of each of them, added together, produced an outcome that none of them had chosen and all of them would spend the rest of their lives explaining. Lehman Brothers survived 158 years because it adapted. It survived war, depression, and the death of its founder's industry. It did not survive the one weekend when everyone in a position to save it decided, for reasons that each made perfect sense, that someone else would. The most dangerous moment in any institution's life is when everyone is sure they know what they're doing.